So continuing with the topic of bond valuation and unit 7.2, we will be discussing types of bonds. So we will be discussing these four types: coupon bond, zero coupon bond, convertible bond, and callable bond. A coupon bond is the bond that we have actually already discussed in unit 7.1, in which you had coupon payments. So if you want to refer to that, you can go back to the previous unit and understand what is a coupon bond. Now let's look into a zero coupon bond. So a zero coupon bond is a type of bond that pays no interest payment but issued at a discount. So it is a bond that will pay no annual interest but is sold at a discount below par, thus compensating investors in the form of capital appreciation. So if you want to, let's say, purchase a zero coupon bond, most probably it will be trading at discount. Discount means it will be trading at below the par value. So for example, if the par value is, let's say, 1000, then this bond will be trading at discount, which means less than par value. So it might be trading at 600. So you will purchase this bond certificate for 600, and if the maturity is, let's say, 5 years later you will get 1000 in return. So the return is coming only in the form of capital appreciation. So let's make a timeline also to understand this even better. So I'm saying is that this bond will be trading at below its par value. So if the par value is, let's say, 1000, so 5 years later you will get 1000, but you can purchase this bond right now for 600. And in the middle you will get no interest payment at all. The only return is this 400 over here, which is coming in the form of capital appreciation. So you purchase it for 600 and you'll get 1000 5 years later, but there is no interest payment in the middle. Usually students ask that, then why would somebody purchase this bond? The reason being simple, that you're purchasing this bond because you're getting it at a below par value price. You're getting it at discount. So the discount is there to entice investors so that they purchase this bond. Now moving ahead. Another type of bond is your convertible bond. Now, a convertible bond is a bond that can be converted into common share at the option of the bondholder. Convertibles offer investors a chance for capital gain if the stock increases, but that feature enables the issuing company to set a lower coupon rate than on non-convertible debt with similar credit risk. So convertible bonds, they are actually giving an additional option to the investor, due to which they might offer a lower coupon rate, because you're giving an additional offer to the investor to purchase this sort of a bond, and the investor might gain, even though it is giving them a lower coupon rate compared to other bonds, the investor might gain if the stock price goes up. If the stock price goes up, they can convert their bond into stocks and might profit from that. Now moving ahead, another type of bond are your callable bonds. Callable bonds have call provision in them. So it's a type of bond in which the issuer has the right to redeem the bond before maturity under specified terms. Most of your corporate and municipal bonds, but not your government bonds, contain a call provision that gives the issuer the right to call the bonds for redemption. The call provision generally states that the issuer must pay the bondholder an amount greater than the par value if they are called. The additional sum, which is termed a call premium, is often equal to 1 year's interest payment. So for example, a bond is issued at the coupon rate of 10% with a par value of 1000 and 5 years of maturity. So if we make a timeline out of this, the coupon payment is going to be, coupon payment is coupon rate multiplied by the face value. So the coupon rate is 10% and the face value is 1000. So the coupon payment is 100. That means at the end of the first year, you'll get 100, second year, third year, fourth year, and fifth year. And at the end of the fifth year, you will get the 1000 par value back as well. But if it is a callable bond, the corporation has the right, the issuer has this right that they can end the bond before its maturity. So they might end the bond, let's say after 3 years. So at the end of the third year, they're going to give you back the 1000 back and the bond is going to end. So you will not get these later interest coupon payments. The bond is going to end over here because the corporation chose to end it at the end of 3 years. So after 3 years, they will give you back the 1000 par value, and with that, the bond is going to end. But usually, what they do, they pay a call premium, which is sort of a kind of a penalty on them because they ended the contract before the stated duration, and that call premium is just one extra year's interest payment. So they might give you this 100 as well. It depends what exactly is the call premium, what has been decided in the contract. Now, another concept that is part of this call provision is your deferred call. Deferred call is actually a duration during which the bonds cannot be called back. It is also called call protection. So during this time period, the corporation is not allowed to call back the bond. For example, if this bond had a deferred call period of 4 years, it actually cannot call the bond until the fourth year has ended. So it cannot call it at the end of the third year. So deferred call is a way of protecting the investors. Also over here, if the deferred call, for example, was 2 years, then there was no problem. The corporation can easily call it at the end of the third year because the call protection will end at the end of the second year. Later on, they are allowed that they can call it back. Now, another question is that why would a corporation do that? Why would a corporation first set a maturity and then decide that they want to change that maturity, even though they will have to pay a call premium on it as well? So, what do you consider would be? So, just take 1 minute and just think about it. It has something to do with the interest rate. So, that is your hint. You need to think in terms of the interest rate. Basically, if the market interest rate, which means the interest rate on the other bonds in the market goes down, that is the time when a corporation is most likely going to call back their bond. Now, why is this the case? For example, you can see over here that the coupon rate was 10%. Let's say that the other bonds in the market at that they were also being issued at this 10% rate. But after 2 years, the other bonds in the market are now being issued at a rate of 6%. Now, the corporation still has to keep on paying an interest of 10%, whereas in the market, their competitors who are now issuing bonds 2 years later are now paying an interest rate of 6%. So the corporation has to pay 4% extra for the remaining 3 years. The corporation is not going to do that. The corporation is simply going to call back the bond if it's not in the deferred call period. They're going to call back the bond and they might issue the new bonds at the 6% rate. So they're going to end this bond, which was issued at the 10% rate, and for that they might issue new bonds at the lower 6% rate. So after this, they will have to make interest payments according to the 6% rate. That means 60. So their interest expense is going to decline. This is called your refunding operation. If the corporation is doing that, which means that they are finishing off this 10% bond and then issuing once again at the lower interest rate of 6%, then that is called your refunding operation. So you can see that the call provision is actually putting your investors at a disadvantage, because the investors were enjoying the 10% rate, but now they will have to go with the 6% rate once the money has been returned to them. So this is actually at the disadvantage of your investors, and they would not like that. So for their protection, you have the call premium and you also have the deferred call protection period. So let me just clear all of this. And we are done with our types of bonds as well. But there are some more types that I would like to discuss. One more type is your floating rate bonds. In your floating rate bonds, actually your coupon rate is not fixed and it floats with the market. This was something that is missing over here, but I think it is important that should be covered. So floating rate bonds are those bonds in which the coupon rate is not fixed. It's not going to be just 10% over the whole duration. It's going to float with the market. It's going to keep on changing with the market. So it might go to 15%, then it might go to 13%, depending upon what is the ongoing rate.